Without a doubt, Peter Lynch is a financial industry icon. He is a renowned investor who became an overnight sensation in the late 20th century with his approach to stock market investment. In this video, I'll show you how Peter Lynch thinks you should invest your money and why it's so important for long-term success, especially since inflation and rising interest rates are this year's central concerns.
Understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, whether, who's the president, who's being nominated for the Supreme Court,
it's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Yeah, but what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yeah.
If we're in a recession, people are not going to spend
That's
as
right.
much money on going to the movies
Absolutely.
or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to
He
tell
can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years from now. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of 82.
Yes.
In 1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
You already know that Peter Lynch's main point is that, sure, the macro is important. Yes, it has an impact on prices. But as an investor, it is one of those things that you can't control. So, since you can't predict it and can't control it, why should you bother thinking about it? This is a trap that many investors have fallen into this year, and it's fair to say because that's all the media has been talking about. But as an investor, you can't get caught up in that type of thing. You must be laser-focused on each possible investment and evaluate each possibility on its own merits.
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. But I'm trying to tell you it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it.
Isn't that what's been going on for the past few years? When interest rates were zero, the market shredded. But now we're witnessing the opposite. Interest rates are rising, but the stock market is falling. Lynch's main point here is that you shouldn't be concerned because when the market is heated and you are performing discounted cash flow analyses, typically, the conclusion is that the stock must execute flawlessly over the next 5 years in order to justify its current valuation. But on the other hand, when the market falls, things begin to shift in favor of long-term value investors. And it's important to remember this. When the market falls, we must have a long-term perspective.
A huge run. I mean, the market was 4,000 just, 2.5 years ago.
Yeah.
And it ran up to 8,300 in August. And, like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow, and it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000, and that caused 7 years of inflated real estate, people overspending, and basically they've been in a recession for 5 or 6 years because their market went up too high. If the market goes too high, you're discounting earnings 7, 8, 10 years out.
Peter Lynch's phrase is indeed a classic, but it really drives home the point that while macroeconomics makes the world go round, it's not something we should be concerned about as long-term value investors. For example, interest rates were higher in 2007 than they are now. But imagine not purchasing a company like Amazon, Apple, or Google because you were concerned about loan rates. In fact, it was clearly a horrible decision. However, even with the market down today, there will still be a large number of investors who will sell their portfolios out of fear that interest rates will rise significantly and stocks will suffer. As Peter Lynch argues, What we really need to be doing is focusing on the earnings of each individual company, on how profitable are they getting more productive? How much cash might they return to shareholders each year? Is that still growing? Thus, we should avoid focusing on the macro. But now that the market is down 15%, what should we do? Is it time to wait and see, or is it time to purchase cheap?
I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. Yeah. That's the kind of numbers you're interested in. Then a 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
That is an excellent point. Nobody knows what will happen in the next 2 years. The stock market might rise or fall during the next 2 years, and there's no telling which way it'll go. However, the likely outcome becomes much clearer after 10, 20, and 30 years. Businesses become more efficient. They either earn more or boost their values, causing stock prices to rise.
We could take a coin out and flip it. I have no idea what the next 1,000 points is going to do. The next 6,000 points are going to be up. The next 14,000 points is going to be up. The next 20,000 points is going to be up.
But you don't know what the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes stocks
didn't exist 20 years ago.
That's what makes Amgen has 2 $1 billion drugs. They didn't exist 20 years ago. New companies will come along. That's what makes this country work.
So, there you have it. Maintain a long-term perspective and keep an eye out for organizations that appear to be very strong. The ones you understand, the ones with a competitive advantage, the ones with extremely well-oiled management teams, and, most importantly, the ones that offer a significant discount to intrinsic value. And this has been the issue for several years. Unfortunately, many amazing enterprises have existed. However, they have all been at exorbitantly high prices. So, for their worth to be justified, they must deliver flawlessly over the following 10 years.
You say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own it.
When it comes to investing in 2023, Peter Lynch's tried and true advice is unparalleled. With over 3 decades of experience as a stock market guru, Lynch advises investors to take risks, but to always be aware of the complete picture. He suggests researching a company thoroughly before investing in order to fully understand the industry and its economic outlook, as well as understanding one's own risk tolerance. Above all else, he recommends diversifying investments, allowing for gains in some areas to potentially offset losses in others. Companies that have real value and potential, Lynch advises being patient and holding on for the long term instead of trying to time the market or chase after trends. Ultimately, Lynch encourages investors be conscious at all times, from when evaluating potential investments to when decisions need to be made about the course of these investments so that gains can be maximized in 2023.